If you have the ability to go to a live event too, that's even better, because meeting someone else who was in your spot 2 years ago that's successfully investing is often, the most confidence inspiring thing you could have.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
All right, everybody. Welcome to a live stream of what will be a podcast for the Alternative Investor Mastermind. I'm your host, Jack Krupe, and have Zach Garizia with me as well. So, Zach, thanks for coming on and doing this.
Thanks, Jack. Thanks for having me. We've been talking about doing this for a while, so it's about time we did one.
Yeah, so today the topic is really about your first year as a passive investor. So going to start by just kind of recapping my story, for those that may not know. And I actually got into real estate in 2001, and that was certainly not passive. I was buying single family houses, I was flipping, I was wholesaling, I was doing all the traditional kind of beginner real estate deals. And, it was a grind. I created myself a job. It was a great learning experience though. And then, I migrated into the mortgage side of the business, buying non-performing loans. Again, that was very active business. It took a ton of my time, and it was a crazy run. But over that time, especially after the learning experience of doing all that by myself, I was looking for other passive opportunities. So what we're going to focus on today is kind of talking through, the mindset and how it happened. And Zach, Zach's going to do kind of a, somewhat of an interview format, but this is going to be a conversation. So,
I got plenty of questions for you, Jack.
Yeah, great. So, so I'll turn it over to you, and you can kind of ask away, and then hopefully, if you're in the chat, feel free to post questions in the chat, and certainly hit the like buttons, and if you're on YouTube, hit the subscribe button as well.
Great. Yeah, thanks, Jack. Thanks for the background. So how did you first really learn about real estate syndication, since you'd been all across the industry, buying your own rental properties, working in the mortgage space? What is it that kind of got you onto syndications in the first place?
Yeah, so I was actively going to meetup groups, it was in New York City. So I was actively networking, and I ran across a guy who had kind of a similar story to me. He'd been dealing with single families. I had gotten started in Rochester, New York. He was from Long Island, but he had been mostly investing in Cleveland, Ohio. Very similar, like trying to go to these cash flowing markets. And he built up a single and duplex portfolio himself, and realized a lot of the same things I'd realized, that it's very difficult to scale. The expenses can grow dramatically. You have one issue that needs a plumber, it may cost $100 or $200 just to get the plumber to go out, and you could eat up your profitable cash flow pretty quickly if there's just minor maintenance issues, because they've got to go to the property, then they may have to go to Home Depot, and then go back, and all of a sudden you're spending 4 or 8 hours of labor for a repair that theoretically shouldn't cost that much to do. So he had moved into the syndication space and was buying. It started as 20 or 30 unit buildings, and eventually, he had gotten to the point where he was doing 100+ unit buildings. And once you're over 100 units, there's a real economy of scale. It's almost institutional quality. There are some larger funds or family offices that will buy, and usually at that stage you have on-site maintenance. It's really like owning a business or a company, not just being a landlord. So because we had the shared story, identified with that. I was following along for a period of time as well. And then, eventually, as I had other cash coming in from, from my other businesses, I started investing passively with him and his firm.
Okay. No, that makes sense. And I guess it's probably pretty good when you get into the industry to start doing these kinds of deals with people that you know, that you trust, that you followed for a little bit. Can you say a little bit more, I guess, about that?
Yeah, absolutely. It's these are generally not publicly available deals. With some of the rule changes, you're certainly, we're allowed to at least talk about them on Facebook. Before the laws changed, it was really, what I'd call a true like country club deal. You really had to know somebody and have an in. Yeah, this is, for me, I was exploring, I was certainly researching and just doing other research online, but, I had the benefit of, meeting someone in person, getting to know him at, at these real estate events. And we actually knew some mutual investors as well. So, there was, other investors I know had successfully already invested with him. And then, I just got to understand the projects and the mindset around them. And it's still very much what JCAM is. One of the key focuses of JCAM today is the value add.
Right.
He was buying tired buildings that were, clean and, relatively occupied, like 90% occupancy, just like a standard, nice, safe, clean building, but it was a little bit old and tired. And when the prior ownership has owned something for 5 or 10 years, eventually they just start, maybe they repaint when a tenant moves out, but they're not doing, a significant amount of work. However, there's a strong demand for these middle-class apartments that are new and clean and renovated. So by putting new kitchens and baths in, there's a strong demand for rent, and rent can increase sometimes a few $100s a month, which adds major, profitability to the deal. Raising by $300 a month can raise the value of the building by $60,000 to $80,000 just by doing $5,000 to $10,000 of renovation. So, I understood the math, I understood the concept. It wasn't rocket science, and it really, didn't require gambling on the real estate market and appreciation. The appreciation was being forced. So I identified with all of that. And also it was a full, full private placement, similar to ours. It's not like it was a willy-nilly joint venture with like a one-page agreement. It was, 100 pages of disclosures. It was, a full operating agreement, subscription agreement, knowing that they were at that level and sophisticated enough to have, and spend the money, because it costs $10,000, $15,000 to put the paperwork together. So
sure,
just knowing that the deal was that legitimate, even though they listed a million risk factors, of all the ways things could go wrong. In a way, it actually made me more confident, just because I knew that, the time and the energy was spent to consult with legal to, do everything in a compliant way to legally raise the money. And in fact, it didn't scare me off at all. It actually made me more comfortable with the deal, that it was, fully legitimate.
Right. Well, and between the costs that come with, setting up this kind of a deal and those incremental, bits of rent growth that you're mentioning, that kind of thing really seems to only work well at scale. And that's, I think, something pretty important that I just picked up on listening to you say it. So this first deal that you did, what part of the country was it in?
So it was in the Southeast. It was actually, on the outskirts of Savannah, Georgia. Mm-hmm. Oh, I'm sorry, Charleston. Okay. Charleston. I mixed Charleston and Savannah up because we're in a Savannah, Georgia deal too.
Yeah, we probably did those right around the same time.
Yeah, similar cities actually as well. So this was what we call a workforce housing deal. So it was within 10 minutes of downtown Charleston. So downtown Charleston itself is pretty expensive, and it's not if you're a bartender or a waiter or just kind of have an average job, it's difficult to afford living right downtown. But it was within 10 minutes of the city, so a lot of the workers who might work downtown in the service industry, that was a main one of the main hubs. They got a lot of tenants that wanted to be close to the city, wanted a quick commute, but couldn't afford to live there.
Sure.
And, and this was purchased before 2016, 2017. So it was well before COVID, well before all of the interest rates up and down. So it was I think it was
before most people knew what syndications were.
Yeah, exactly. So and it ended up close to a 5-year hold. We actually held it through COVID, and COVID was at first was a little bit scary, but overall, as we saw, most of the deals performed pretty well during COVID, especially once the assistance came in, and there was a fair amount of programs for rent. I mean, this one probably had a little bit harder hit than others because there were a fair amount of tenants in the service industry, but collections never really dipped below the 85% range, and then when the assistance came in, I think overall collections ended up 90% plus. And then fortunately, in the big run up in 2021, we were approaching the 5-year hold. Which these deals can range from 3 to 10, but there was a big run up in prices, and this actually sold probably pretty close to the peak. In 2021 when rates were record low and everyone was the real estate prices and
piling into the space.
Yeah. So it really worked out to be a great great first deal.
Right. Yeah, no, it sounds like it. And since you mentioned, Savannah, Charleston, it sounds like most of the first year that you were doing these passive syndications, was it pretty much all focused on multifamily, pretty similar size, concept, thesis?
Yeah, that was the main one because that was I'd been in the rental business for a long time, so I really knew it. So the first few deals were in that asset class, but I was also continuing to research the other core asset classes, including self-storage, mobile home parks, as well as student senior housing. I did do a deal. Actually, my second allocation was actually to a group who I knew. I met them at a conference, but it was a conference sponsored by a group I'd done a ton of business with on the mortgage side. And they actually had an allocation, partially self-storage, partially mobile home parks. And
interesting combination.
Yeah, and that was actually more of a fund of funds, and it's really one of the groups that inspired the way we structured JCAM was that group that I'd invested and actually I did that personally because that was well before the fund. But yeah, I still get a check I get a deposit every month on that deal as well. And more importantly, got to dive into their reports, review their monthly reports, review just what their mindset was what they were allocated to, and got to see the performance firsthand. There's no substitute for I certainly don't advocate people just willy-nilly jump right in, but there's really no substitute for putting your money where your mouth is and investing. And I'm not against education, but I over the years, I'd seen so many people that spend so much money on, say, like a boot camp or a mentorship program. And, depending on your personality type, sometimes you could learn more by taking that money and actually doing a deal than, just writing a large check and sitting in another class and getting analysis paralysis. So there's pros and cons of both. But for me, given where I was in New York paying the top tax rate as well. So for me, it was a way to get tax deferred income because all of these losses showed losses on paper. So it was like, hey, I'm going to get I'm going to get positive cash flow, a good tax write-off, and I could learn at the same time.
Yeah, no, it makes a lot of sense. And so when you're looking at these initial deals, you mentioned looking for tax benefits, workforce housing, different markets throughout the U.S. Can you say a little bit more about, I guess, what you were looking into this first year when you were really choosing deals and kind of establishing your thesis and establishing the thesis at JCAM?
Yeah, so it was certainly the sponsor came first. It was, did I trust them? Was I confident they weren't going to run away with my money? Was I confident they knew what they were doing? And they both coincidentally were, groups that had a similar mindset. The first group, we both had done single family. We had shared experiences. The other group, similarly had been around since well before 2008. So they'd seen some cycles. They've seen when things go bad. And that's one of the things that's extremely important to me too, is, just what happened to them during the financial crisis, or that they're just not, that they don't have that irrational exuberance that real estate's just going to go up, and that they're prepared to meet some challenges. And, that's been super valuable. We can get to that later, but, with the rise in interest rates, there's been some great navigation of that with some of our key partners that were well equipped to still make things work even with interest rates going up. So it was really, first the sponsor, and then, did the deal make sense? We covered the value add. That was and still is a big part of it for me. Is, if the business plan is to increase rents through renovation, do I believe in those numbers? And when we set up our call to review it, I play devil's advocate and and really make sure they knew they could sell it to me. We would talk about the other neighboring complexes. I would, go on Google and look at the 3 apartment complexes nearby and make sure they were aware. And I could say, well, how come this place has rents at if you're going to get $1,300 in rent, why is the place across the street at $1,200? And the good answer was, I toured that personally as like a secret shopper, and those units are not renovated, or they're not the same class. They're not the same, they're smaller. So those were the good answers to me, to show that they absolutely knew that area and neighborhood like the back of their hand. They'd really done their diligence. Yeah,
well, that I guess allowed you then to make these investments from New York, from Puerto Rico, recently from Buenos Aires, from all over the world, as long as you had these trusted boots on the ground who knew their markets and could go in and find, the best deals and make sure that everything, like you said, made sense for the passive investor like yourself.
Yeah, absolutely. And then, it's once you're in the deals and you're really doing your work up front. So, I've used the term active passive investing, and that's what we're doing. I was in Buenos Aires, then I immediately went to Orlando for a conference that had over 500 people there as a boot camp by Rod Cleef. And, there were a lot of people, there was a mixture of people just trying to learn and get into the business, but there was a core group of the veterans that were there that have, been there for many years, been in many deals. And, fortunately, I know a few people already from some of the other groups I'm in. So was really able to mastermind with like 20 or 30 really experienced operators, and, some of which we'd invested with, but others that we're getting to know. So, and we will, stay in touch with them when there's future opportunities that come together. So this is where we're getting the market insight as well of, some of the challenges, because there are certainly some groups feeling some challenges right now as well. So that's where all the work is up front, so that when a deal happens, it's with a group that we know very well. We know their track record, we know their capabilities, we know their mindset and how they think about opportunities, and when we know that their ability to execute once things close. Because the reason I want to be in this space is there is that size and scale that you're not dealing with all the bad teas, no tenants, no toilets. I'm not getting that 2 a.m. phone call because of an issue, because I know we've got a team that's has boots on the ground that is better prepared to do than I would.
Right. Well, and you're also, like you mentioned earlier, you weren't out having to make calls to collect rent during the start of COVID. You're still collecting your check. Would you say that so far, with most of the syndications, just based on your experience as an actual landlord yourself, have the returns differed a lot that you saw for your own cash flow as a landlord versus syndications? Have they been pretty similar? What does that look like?
They've been, even with some of the COVID challenges, I'd say they've been more consistent. When I had a single family portfolio, 1 month it might be great, and then the next month, we had 3 vacancies and a couple unexpected repairs, and we're cash flow negative for the month. So take out the properties that the few that had variable rate debt, where it was supposed to be a short-term hold, and maybe you're going to have to transition into a longer-term hold, where with fixed rate debt, the cash flows have been very consistent. The expenses, when you have 100 or 200 units, things average out. You have a full-time maintenance person, so rarely do you need to actually have some repair that's going to cost tens of thousands that's unexpected. It's usually you know, a clogged sink, a toilet, a fixture, fixing a light. And also when there's a value add, a lot of the renovation and the capital improvements are budgeted up front too. Going into this, it's like you kind of know what the big expenses are and you have them reserved up front. You know, maybe it's 100,000 for paving a parking lot. It's you know, you're going to do, you know, you're going to redo the barbecue grill area, you know, do some tenant improvements to improve the lifestyle, fix the roofs. Those are all budgeted for ahead of time. So there's a lot less surprises because it's actually required by the lenders as well. At this size and scale, you know, you're going in and there's so many professional eyes on it. You need the professional inspection. You need the bank. The bank is going to want to have a list of the capital improvements. They want to know that you have the money for them in reserves ahead of time. And often it's built into the bridge loan as well, where the bank will actually increase the amount they lend to you, similar to like a hard money loan. But you know, you do your repairs, then they'll actually reimburse you and then, you know, raise the balance of the loan for it. So there's a lot less surprises. You know, with that said, you know, with interest rates rising, there are some groups, and I met a number of them at the conference that, you know, are not making distributions currently because the additional interest rates are really eating up what would have been the cash distributions. But most of the deals that are heavy value add, most of the money was made on the back end. It was not like you were getting 10, 15% cash on cash from the monthly rents. It's really often 4, 5, 6, 7, 8% at most from the rents, and then a bulk of the return, you know, and often, you know, the goal is 15 to 20% annualized on the sale. A bulk of it comes from the sale. So, so on that side of things, obviously there's been a little movement, but on the actual performance of rent collection expenses, it's much more consistent.
Right. No, and it makes sense, and especially when you're talking again to the theme of scale, diversification. I guess that makes sense as to why you started the diversified fund as well, right? So that you could even spread that risk out a little bit more across more operators, more asset classes, more geographies, and scale the business that way.
Absolutely, and that has smoothed out cash flow as well. So, you know, our first fund is in 30 different allocations, and of those, there's a number of them that have low interest rate, fixed rate debt. They pay like clockwork. And we have some other deals that were really more about, you know, the renovation and sale that weren't really meant to pay much cash the first year or two. And then we have some, you know, a few ground up construction deals. And I know a lot of individual investors that would love to, you know, make the highest return possible, but just can't go 3 years without a single payment just to get one lump sum at the end. So we're able to blend those two together, and we still have some cash flow coming in. So we distribute quarterly. And at the same time, we have some deals that have a lot of upside on the back end that, you know, at this point are pushing, you know, we're in year 3 of the fund. So we have some of these deals are, you know, getting closer to coming to fruition with, you know, a large cash out from a profitable sale.
Right. So that's how you've really been able to balance the portfolio, I guess, when you're looking through each individual deal, making these decisions on a regular basis, right? It's not like you're just doing one syndication a year, 2 a year, like a lot of individual investors might be able to. You can choose deals for cash flow, for appreciation, for tax benefits, of course, combine it all. So, Jack, would you say if you had one, I guess, piece of advice for someone who is maybe a little bit newer to investing in syndications, maybe not a professional in the industry, is there one major piece of advice that I guess sticks out to you more than anything when looking, I guess, back to your first year and also to where you are now, almost 10 years later?
Yeah, I mean, I think you got to take action in some way, and you know, listening to this, if you're stumbling across it, is the, you know, is a start. There's tons of content out there right now. We put out content. There's various podcasts. There's, you know, the Bigger Pockets forums. There's various Facebook group. There's so much content to digest. You just gotta start and just dive in, and then certainly reach out. You know, we have both our funds, but we also have the Alternative Investor Mastermind, this podcast. And I do look at it as an actual mastermind. We're growing our Facebook group as well. And, you know, there's no one central place to get information. You know, especially everyone's situation is a little different. You know, it depends on if you have a W-2. Are you looking to get out of your W-2? Or are you looking to just build for retirement? And, yeah, there's a lot of great conversations that we've had with investors, just, you know, informally, just discussing, you know, their situation, their strategy, how we may be able to help, how we may be able to refer other options that may be able to help them as well, whether it's rolling over a retirement account into self-directed, or other strategies that may be tax efficient for them. Just things that I've looked into personally that I'm certainly not an official financial advisor, but I've lived it. I live this business, so I love sharing information. So just dive in, and you're going to find like-minded people. If you have the ability to go to a live event too, that's even better, because meeting someone else who was in your spot 2 years ago that's successfully investing is often the most confidence inspiring thing you can have, that hey, they're doing it successful. They've this is how it's impacted their life. They can grow their portfolio without worrying about the stock market dropping 20-30% like it did last year.
Sure.
So you just gotta take action. You gotta get into the club, if you will, because it's sort of a private club of those that are aware of all these options outside the traditional financial system.
Right. Take action, work with experts, and really just go from there and learn along the way. And it makes a lot of sense. And I see, of course, why you're in the space. It seems like it's been quite successful. So, Jack, that really answers my questions. I appreciate this. I've learned a lot.
Yeah, it was great. It's a great chat, and I think we're going to try to do these more often. So for those listening, please hit the like button, hit the subscribe button. I think we're on both LinkedIn and Facebook currently. So send us a friend request, follow us, and let us know what questions you have, and we can perhaps address them on a future episode. Also, check out the Alternative Investor Mastermind on Spotify, Apple, or your podcast platform of choice, as well as YouTube. So thanks for listening, and we'll see you all in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.